In this video, I want to answer the question, what is a discounted cash flow, a DCF? Which would you prefer? The offer of $1,000 today or the offer of $1,000 in 2 years' time? I'm guessing you'd say you want the money now because you can put it to work. You can invest it so that in 2 years' time you might have $2,100. So, what if I said to you, you can either have $2,000 today or $2,100 in 2 years' time? Is that a good deal? Well, on the face of it, it's equivalent to getting something like 2 to 2.5% interest. Is that a good rate? Maybe you think it isn't. In which case, what about $2,300? Maybe you think, no, I want the $2,000 now. So what if I said $3,000 in 2 years' time or $2,000 now? At what point are the two figures equivalent? That's the problem that discounted cash flows solve. So what's a cash flow? A cash flow simply records the flows of cash in and out of a project or a business on a period by period basis. So for each period, we record the flow of cash in and the flow of cash out, so that at any point in time we can total all the ins and all the outs and figure out whether we've got a surplus of cash or a debt or a balance. But cash has a time value. That is to say, the same sum now and the same sum in the future are not worth the same amount. We know that inflation erodes the value of money. $100 now may only be worth $99 in a year's time in terms of spending power. But we also know that we can invest our money. $100 now put into the bank may turn into $102 in a year's time if you get 2% interest. So what a discounted cash flow does is it applies a percentage uplift to each cash element based on two things: a rate of return and how long has elapsed between now and when that cash comes into or goes out of the cash flow. Calculating what the right rate of return is an economic problem and not one that we as project managers need to concern ourselves with. We'll be given the rate of return to apply by our organisations. But when you've got your discounted cash flow and you've applied those rates of return correctly, then the cash value after the rate of return is applied will always be expressed in terms of the present value, and the cash figures will be equivalent. So once you've calculated a discount factor to apply to each of your flows of cash, and you've applied those discount factors, the numbers will be equivalent. If you receive $100 today and $100 in a year's time, and you've applied the discount factor and the $100 in a year's time is reduced to $99, you can be sure that that's the present value of the $100, and you will know that $100 now is worth more than $100 in a year's time. It's as simple conceptually as that. That $99 figure, that is what happens when we receive $100 in a year's time and discount it down, is known as the present value. And if you add up the present values of all of the flows of cash, you get the net present value. If all the investments and all the returns come to greater than zero, a positive net present value, you've got a positive return on your project. And for project evaluation, when you're doing your investment appraisal and building your business case, the question is, what level of net present value will justify the project? There's another figure we often calculate, which is the internal rate of return. If we get a positive net present value, the internal rate of return gives us the figure that if we invested all of the sums that we've invested, what is the equivalent interest rate we will generate. So another way of establishing your business case is to calculate the internal rate of return and show it's a greater percentage than you can get from investing the money in other ways. Now, if you're a project manager who is not skilled at spreadsheets and mathematics and perhaps even accounting, then you almost certainly shouldn't be building your own discounted cash flows and DCF models. Get a qualified colleague to do it for you. But as a project manager, even if you don't understand the maths behind it, you do need to understand the basic principles so that you can talk knowledgeably to your colleagues and understand what is required when you build a business case and create your investment appraisal. If you've enjoyed this video, please do give us a thumbs up. Please subscribe to our channel, and why not hit the bell so that you get notified twice a week of the new videos we create. And I'll look forward to seeing you in the next one.